who will promote the policy, who will formulate the policy, who will prepare the policy, who are all they? 3 people nominated by the Reserve Bank of India. If the bank mobilize 100 rupees, they cannot spend 100 rupees. There are some statutory rules by Reserve Bank of India. This is Venkateshwaralu on behalf of Guidely, having experience as a panel member in IBPS and 35 years of service in State Bank of India in a senior position. We are capsuling and we are in a concise manner, in a simplified manner, in a one-word answer. We are providing you material for the purpose of interview only. Yes, this is nothing but for an interview. And as far as interview is concerned, it is like a one sentences. It is not a descriptive, it is a simple sentences. Let us say first, yes, monetary policy of RBI. Why RBI must have a monetary policy? RBI main function is, it has to control the money circulation in the country. How? With some of the monetary policies. What are they? Let us see. To start with, yes, monetary policy is an economic policy, the first, and manages the size and growth rate of the money supply. So, Reserve Bank of India, to control the money circulation, to increase the money circulation at an appropriate time, it will have the monetary policy. On the basis of the monetary policy, it will increase or decrease the money circulation. Yes. For monetary policy, Reserve Bank of India, who will promote the policy? Who will formulate the policy? Who will prepare the policy? Yes, the Reserve Bank of India, it is having a committee. It is having a small committee. That committee, Monetary Policy Committee, that committee is called Monetary Policy. It is set up by the Union government to set the policy, interest rates as a part of its monetary policy. These people will be taken care by the interest rates in the country and how to implement the schemes and systems of the country on the basis of the rate of interest. It is proposed by the Government of India. Who are all they? Who will be selected? Let us see here. The monetary policy will have 6 members. The monetary policy will have 6 members. What for? To take care of the interest rates, to take care of the growth. Yes. Who are all they? 3 people nominated by the Reserve Bank of India and 3 people nominated by the Government of India. Let us see here. Yes. The Monetary Policy Committee of the Reserve Bank of India has 6 members. Start with 3 of whom are selected by the central government and 3 whom are from RBI and governments. 3 plus 3. Then finally, the members of the Monetary Policy Committee appointed by the central government should hold office for a period of 4 years. So, monetary policy consists of 6 people. 3 from government, 3 from Reserve Bank of India. How many years they will be in the committee? They will be in the committee for 4 years. What for? To take care of the economy and injection of funds and taking care of the loans and advances, the rate of interest. Yes. Now, the object of the monetary policy. Number 1, high employment opportunity to be provided. Second thing, economic growth. Not only employment, but also economic growth has to be taken care by the Monetary Policy Committee. And price stability, interest rate, stability of financial market, stability of foreign exchange. So these are the main functions of the Monetary Policy Committee. Monetary Policy Committee consists of 6 people. Okay. Who are all they? 3 from governments, 3 from Reserve Bank of India. Nice. Up to what period they will stay? 4 years. What is the object of this monetary policy? First, foremost is rate of interest only. First, they will fix interest rate. Why interest rate has to be fixed? Basis of the interest rate, if more interest is given to the depositors, we will get more deposit. We will mobilize more deposit. This amount will facilitate for economic growth, price stability. Second thing, we will extend loans and advances at a cheaper rate of interest. If we give loans at a cheaper rate of interest, employment will be more. So automatically they will take care of the employment opportunity, high employment. Then coming to the financial market, so there will not be any fluctuation. If the money circulation is less, rate of interest will be more, private finance will be more, usurious rate of interest will be more. So cut short all these things, financial stability and foreign exchange stability. Now let us see the monetary policy committee meet how many times in a year? They will meet exclusively 6 times bi-monthly or maximum 6 times in a year. This monetary policy consists of 6 members, 3 from government, 3 from Reserve Bank of India will meet to take care of the employment, economic development, rate of interest, stability of financial market and foreign exchange. Now coming to the, what are the things they will take care of? Particularly the Reserve Bank of India. It will mainly 2 things, repo rate and reverse repo rate. Repo rate, reverse repo rate. What is these 2 things? If the banks borrow, Reserve Bank of India is called a bankers bank. So banks will borrow money. If banks will borrow money, the Reserve Bank of India will charge interest. RBI charging interest is a repo rate. Let us see all these things in field. So repo rate, reverse repo rate, open market operation, discounted rate, CRR, cash reserve ratio, SLR, statutory liquidity ratio. What it represents? In a graphical manner, we are showing these things. Open market operation, bank rate, cash reserve ratio, credit ratio, margin loaning and mortgaging and selective credit control. This is most important whenever required by the banking industry. To start with, what is a repo rate? Repo rate is the rate at which RBI lends money. So in other words, repo rate is the rate at which RBI charge from the banks for the amount the banks borrowed. So automatically, second one is a impact of repo rate. Impact of repo rate. When the Reserve Bank of India hikes the repo rate, the commercial banks have to pay more to the borrow money. So if the Reserve Bank of India increases the rate, the borrowing by the scheduled and commercial banks, they have to pay more interest. In turn, they have to charge from the customers. So to overcome these things, they have to maintain the repo rate in such a manner which is comfortable. So repo rate hike reduces the money supply. If the Reserve Bank of India increases the repo rate, it will reduce the availability of funds. On account of increase in repo rate, what will happen? Let us see. Rise in market interest rates. When the banks borrow from Reserve Bank and if they interest more interest, they have to charge more interest from the borrower. So in the market, the lending rate will be more and decrease in consumption. So people will decrease their daily things. For instance, I am having 500 rupees. I can take a cup of coffee. I can take in a 3-star hotel or in a good restaurant. If I am having a 20 rupees, I will take in a smaller restaurant. So when interest rate is increased, the money circulation is decreased. On account of decrease in the money circulation, the consumption will be less. Now, what is a reverse repo rate? Repo rate is the rate at which RBI charge. Reverse repo rate is the rate at which RBI pay. Why a Reserve Bank of India has to pay? The bank's excess funds will be deposited with the Reserve Bank of India. So, Reserve Bank of India will pay interest for the amount deposited by the scheduled and commercial banks. Now, what is the impact? What happens when the reverse repo rate is increased? If the repo rate is increased, consumption will be less, money availability is less and borrowal will be less. If the reverse repo rate is increased, an increase in reverse repo rate means that commercial banks will get more incentive. So this is the benefit available to the scheduled and commercial banks. When there is a excess liquidity in the market, then the reverse repo rate comes into play and absorbs the liquidity from the market. So whenever the banks are having more funds, it will deposit with the Reserve Bank of India and they will receive interest. If the reverse repo rate increased, the deposit by the scheduled and commercial banks excess funds will be deposited with the Reserve Bank of India more and more. Next comes to the bank rate. Yes, bank rate is the rate. Bank rate is the interest rate at which central bank lends money to domestic banks for short term. Repo rate is the rate at which Reserve Bank of India charge for borrowers, and bank rate is the rate at which Reserve Bank of India will charge for a short term loan. The scheduled and commercial banks will borrow from the Reserve Bank because Reserve Bank of India is a banker's bank. Hence, Reserve Bank of India will charge interest. That interest is called bank rate. Bank rate is also known as a discount rate, a small rate. Now come to the CRR. The Reserve Bank of India is having two statutory rules. All scheduled and commercial banks has to follow two statutory rules. That is, if the scheduled and commercial banks, if the bank mobilize 100 rupees, they cannot spend 100 rupees. There are some statutory rules by Reserve Bank of India. They have to maintain some amount with the Reserve Bank of India as a reserve to meet any contingency. So what are those statutory obligations? One is CRR, called cash reserve ratio. Another one is called SLR, statutory liquidity ratio. CRR is maintained in the form of cash with Reserve Bank of India. Here we can see cash reserve ratio, banks' total time and demand liabilities. Cash reserve ratio is the percentage of banks' total deposits that needs to be maintained as liquid cash with RBI. It is used to regulate the money supply level, inflation and liquidity in the country. So in other words, cash reserve ratio is one of the statutory obligation to the bank. The banks has to maintain with Reserve Bank of India in the form of cash is called cash reserve ratio. Under cash reserve ratio, they have to maintain only in the form of cash with Reserve Bank of India. This amount will be utilized by the Reserve Bank of India for liquidity purpose. Another statutory obligation is, yes, if the CRR decreased or increased, what will happen? If the CRR is decreased, availability of funds to the bank will be more. For instance, RBI increases CRR, available of funds will be less, whereas RBI reduces the same and availability of funds will be more. For instance, as of now, CRR 4%. If the Reserve Bank of India increases from 4% to 6%, the available funds with the Reserve Bank of India will be less. So automatically, it cannot lend to the concerned people. Similarly, if CRR reduced, availability of funds is more, then the banks will extend more and more loans. The second obligation is SLR, statutory liquidity ratio. CRR is maintained in the form of cash with the Reserve Bank of India. SLR is maintained in the form of cash, gold or bonds, securities. These things, they can maintain SLR with them only. They need not deposit to Reserve Bank of India. They will keep with them. Let us see the rationale. Yes, SLR is the minimum percentage of deposit that a commercial bank has to maintain. The commercial bank has to maintain in the form of liquid cash or gold or other securities. If the SLR increases, again same thing. If the SLR increases, it restricts the bank's lending. If the SLR increases, available funds with the banking industry will be less, so it will be restricted from lending. The difference between CRR and SLR. CRR is the amount maintained in the form of cash with Reserve Bank of India. With the Reserve Bank of India. SLR in the form of cash, gold or securities to be maintained with them only. Then what is the return? For CRR and SLR, nothing. CRR, no interest and no return at all. No return. Whereas in SLR, because it is with them, under SLR, the securities will be in the name of the bank. It is with them and it can fetch return. and maintained with RBI, maintained with the bank itself. So let us see in a flow chart. It gives CRR is the deposit bank's ratio, and it is held in the form of cash, and it controls the flow of money, and it maintains with RBI. Whereas here SLR, it leads to the, as per the bank deposit, they have to maintain. SLR held in the form of gold, cash or securities, and SLR helps to meet sudden demand, and SLR has to be supported by the bank, and it is kept with the concerned bank only. Now let us see marginal standing facility. What is a marginal standing facility? Marginal standing facility is the rate at which banks borrow from the RBI against government approved securities. If I have, you see, SLR or excess funds will be invested in shares and securities, bonds and securities. So whenever the banks required money, they will pledge with the Reserve Bank of India and borrow money. For borrowing against a security, the RBI will charge interest. That is called marginal standing facility. RBI provides money to the scheduled and commercial bank who are facing an acute shortage. The rate differs from the repo rate and bank rate. Now, what is liquidity? Everyone know. In the villages, you can say, if you request the people to deposit in the banking industry, they will say, why I have to deposit? If you request the people in the rural area, in the village, to deposit the money in their possession, they will say, no, I will keep my money with you. Whereas this is called liquidity. Whereas if we deposit in the bank, you cannot find money. But as of now, we are having so many facilities, neo banking, internet banking, withdrawal from ATM. So you need not worry. So as far as liquidity is concerned, it is the component of cash. Liquidity is the ease with which asset or collateral can be converted into cash without losing the money. The commerce graduate, accountancy graduate will say, what is the current asset? Current assets are nothing but convertible into cash within 1 year without any difficulty. So that is called same thing. Liquid is nothing but it is easily convertible into cash. Now, open market operation is there. Under open market operation, purchase or sale by the government securities. So, open market operation is related to the purchase and the sale of securities. And one of the most important way of monetary control that is exercised by the central government is exclusively supply in the economy. So, the Reserve Bank of India, whenever they require to increase or decrease money circulation, open operation market will take place. Under open market operation, the government will, the RBI, in order to expand or contract money circulation, it will have purchase or sale. To increase or decrease money circulation under open market operation, RBI will sell or purchase securities. Yes, it is a flow chart.